morning, everybody. It's a pleasure to see you. And I'm going to talk about why fundamental analysis is still key in a time of volatility. But before then, I'm going to start with an interesting story. I mean, years ago, this was like 2013, 2014, I used to run an emerging market fund. I used to travel the world, going to different countries. And I think this was Howell's statement about sanctions working in Russia. And I'm going to give you a practical example of why these things are complex. And I remember back then, Russia had actually annexed Crimea, the province of Ukraine. So this is a prelude to what's happening now. And I remember going into a Russian retailer, which we had invested in back then, and walk around, and there were already sanctions then because Russia had done a bad thing. And I remember we walk around, and I see these apples. These apples are like, got South African stickers. But I thought, hey, guys, but I thought you weren't allowed to import stuff into Russia. And suddenly it turns out that no, these apples stopped being South African because they'd been routed through Georgia and Ukraine at that time. And so therefore, someone had figured out an easy way to go bypass the sanctions. And so human ingenuity is astonishing. And so that I thought, wow, what an interesting story. But let's get on to my story. The year was 1978. Hal showed you some long-term charts on inflation. 1978, this man over here, Ronald Reagan, was a president-elect. Inflation was high in the US, and it was about 8%, and he was talking about how inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. At that time, he didn't realize that inflation would go further up. But let's talk about inflation. Inflation, clearly, we've got this chart in our long-term perspectives document, fantastic document to go through, and it shows inflation on retirement income of 10,000 Rand over time. And you can see the higher the inflation, the worse your actual income is. So inflation is a problem. And so therefore, let's talk about how to invest in a time of inflation. And I love this particular cartoon. It's going to get worse before it gets better, and then we'll cross out the before it gets better. But I love this line at the bottom over here. Recent leading indicators have forced me to revise my economic outlook. And actually, from an investment perspective or economic perspective, that's exactly what's been happening. Everybody's been on the back foot, everybody's been getting surprised, and everybody's revising negatively because things are getting worse faster than either of us thought. And I'll take you through some of our changes. But let's go back to 2020. 2020, these are the funds that my team and I manage. 2020 was tough. It was very, very difficult. When I heard Hal talk about people living to 150, I thought, as a portfolio manager, that's the last thing I want to do. I will not survive to 150 if the world is as volatile as it has been. We were positioned poorly, I suppose, over here running into 2020, and our funds and our, obviously, clients suffered because of that. And largely because of what happened. We were positioned in South Africa. We were very bullish about South Africa, and we saw opportunity in South Africa. We were also positioned in a company named Sasol, which went all the way from north of 400 down to 33 Rand. And you can see at the bottom, that's South Africa Inc., the small cap and the mid cap. The only things that performed in 2020 then were Naspers and resources. But actually, time proves you wise sometimes, because if you go from that point, from October, where that other chart, South Africa, all of a sudden, mid-cap, small-cap, that outperformed, and Naspers underperformed. And so therefore, it turned out that actually patience was rewarded. But again, investing is volatile. It's tricky, and it is all over the show. And so, what did we think? We talk about themes, and I'm going to explain what themes are, but what did we think in 2020-21? So on my right-hand side, your left-hand side, global themes, we saw earnings over ratings. What do we mean? We saw earnings. We saw a recovery from COVID, that company earnings would be strong and stage a strong recovery. And we saw that. We saw regime change. We saw higher medium-term inflation. This is in 2020. This is our chart from 2020. We thought inflation was medium-term going to be higher. All of a sudden, we're like, okay, well, we underestimated that. We saw a cyclical recovery that played out. We saw a cyclical recovery in South Africa, and hence the small caps outperformed, and we were positioned for that. The banks outperformed. And then cash is trash, which is one thing we said, well, inflation will be well managed in South Africa. We're going to have lower rates for longer, and money must find a home, and it's not going to be in cash. You're not going to get much return from cash. And so things kind of worked out for our cause, but even we, who kind of saw the future and looked into the future and thought, this is what should be happening, underestimated it. And so therefore, This is Economist article. This one was from 2004, saying back to the 70s, talk about inflation. And this is 2004's one. And why did I choose this one? Because the idea of inflation returning has been called many times. And many times we've been wrong. And this time, though, seems like, hey, maybe this is different. And obviously, Sid, Hal showed you US, the G7, Germany, China. You can see inflation is rising. And in this particular chart, it's CPI inflation excluding food and energy. And those are the things that actually matter. Because once you start including food and energy, hey, you are starting to head back to where the 70s were, especially in the US. And with inflation comes wages, because what people are asking for, that actually naturally goes high, and that fuels tension. And remember, we invest in companies, and when wages go up, margins get squeezed unless you can pass your profits on. And so therefore, companies' earnings power, depending on the quality of the company or the structure of the company, that comes down. And if companies earn less profits, which means people are going to pay less for those companies, your returns are going to be under pressure. That's the power of inflation. That's why it's dangerous. And these are what we're seeing globally in terms of inflation. Globally, this is an issue. And that one over there in the black and white, that was in the US. This is back in the 70s and 80s. It has social tensions. So inflation has a thing. So how do you invest in a world of high inflation? So in terms of how we look at the world, we look at the world in two dimensions. And the gray line over here is what we say the fair value of an asset. And then ideally you want to sell when it's expensive and buy when it's cheap. But not everything that counts can be counted. Not everything that can be counted counts. What do I mean? The idea of saying I'm going to sell at the top and buy at the bottom sounds fantastic. It is very, very difficult to do because the price is not the only thing that we believe drives an asset. Because sometimes you can see the green line, if you sell at the top and it comes down to the fair value, generally then you are okay. But sometimes the purple line you can show you that assets can continue falling further than you thought when they were cheap, which can obviously from a client portfolio lead to underperformance. Or assets you buy at the bottom, it will go up to the fair value, but actually, what if it continues further? So we look at the world in a world where we say the theme. We talk about theme and price. What is a theme? A theme is an environment. An environment, in us, it's a macro, an industry, a company, or an ESG factor. A macro is inflation, which I'm going to talk about. That's a macro theme. An industry is an industry that is consolidating or regulation within an industry that is changing profits. So Tencent, Naspers, Process, those companies have an industry theme of regulation, which is eroding profitability. But a theme has to have extent, so it must be there for a long period of time and must lead to changes in earnings on profitability of a company. And when you look at that, then that gives us our four dimensions where you've got price. If it's cheap, you buy some, but the theme must be improving. So you need an environment that is favorable. You need the tailwinds to help you out in terms of actually extracting proper returns. Now, let us get into this in terms of what do we see in 2022 now? What are our themes? So what is the environments that we are investing in? We say global wave down, we see an inflation shock, I've spoken about that, a rates shock, Hal's spoken about that, and then a growth shock. So we're saying, hey, there's a shock here. Recession risk elevated in the US, earnings expectations are too optimistic in the US. Why? Also, we look at, I talked about wages. I said wages are just coming up, and that's going to impact profits. If you look at the FT this morning, Google is saying, hey, we're going to start retrenching. Apple is saying, we're going to start retrenching. These are the biggest and most profitable companies in the world, and they're talking about reducing staff. Goldman Sachs is saying, hey, we're going to, this is today's FT. Large global American companies saying we've got a problem. That means those earnings that they're going to report the end of next year are going to be lower. The prices then will come down too. So follow that, US to underperform. So, and this is where it gets tricky with investing. Because in South Africa, I'm going to talk about this at the end, where we talk about, offshore, onshore. Whenever you go offshore, generally the benchmark that is used is the MSCI Equi, All Country World Index. 60% of that is the US. So, okay, so you run away from South Africa, you've got some issues, but where are you going? Investing is hard. It's complicated. Anyway, US companies are on very big margins, helped by the stimulus in COVID. We're saying, hey, those margins are coming under pressure. Wages are coming up, interest rates are coming up. And remember, American companies didn't pay any interest, really, because interest rates were at zero. But as interest rates go up, your interest bill goes up. And people spend their money, your revenue's coming off because people have less money to buy. So from an income statement of a company, the revenue's under pressure, the costs are going up, your interest bill is going up. What happens to your profitability? It goes down. Oh, people are not going to pay lots of money for companies whose profitability is reducing. So what do you do with that? And in South Africa, we're saying the tailwinds are fading. That COVID recovery is played out, which is true in certain sectors. It's less favorable global environment. South Africa does well when the world is doing well. We export commodities, so we need people to be building things and doing things. That's what works for us. Structural reforms are required to lift growth. So South Africa, we focus on companies that we say are long-term winners, that we focus on that actually can do this. South African bonds are fantastic, actually, because they're offering, the 10 years, 11.5. That's a very, very good return. It's very difficult to get that elsewhere. And so that's where we are tilting some of our multi-asset portfolios. Now let's come back to inflation and look at some statistical data. I talked about theme and price. We do lots of research. History is an amazing lesson. Basically, at the top, inflation regimes are 1926 to 2021, and returns at the bottom. What I want you to pay attention to is on the other side. High inflation regimes are not good for returns. And so therefore, we manage multi-asset funds, say the balanced fund, which I'm going to talk about here a little bit. At the end of the day, CPI plus 5 is our target. That becomes much harder to get the higher inflation is and the more inflation persists. That's an important statement to put out there. It's the truth. So now let me take you through further research. So then we've studied various, 1970 to 2021, inflation resist Goldilocks is a good environment. You can see here, growth is high. So these two have growth high, inflation low, inflation high. Goldilocks is, this economist termed this term about Goldilocks of the three bears. It's when growth is good enough to keep the bears away, bears being the bear market. And so that's a good environment. You see the return 15.1%. Reflation is a recovery. It's the cycle we've just come from. Which is from COVID, where lots of stimulus, the world recovers. And you can see, again, returns are good. But if you come to the other side, when growth is low, whether inflation is high or low, your returns aren't good. And so therefore now we're facing an inflation world. You can see it's the lowest in terms of the investment cycle's potential return. And if we go to deflation, which is then a recession, actually that gets, I suppose, also quite testy. So the conclusion over here, regardless of the inflation environment, you've also got to pay attention to growth. If growth is poor, so then our returns. So we're painting quite a tough scenario here. So therefore, we went further and said, well, what do we do? How do we study? So we did some research again, and we looked at sectors. And so we looked at sectors and say, well, there are certain companies that have pricing power, an ability to price, and actually say, hey, we can charge. So tobacco companies are wonderful in that because they sell an addictive product, and every year they increase the price of that addictive product. Beer companies, those are called consumer staples. And you can see they're good margins. You can see different sectors by margins, but you can also see what's important is volatility. So the change in that company's stability of profitability. Like you can see the consumer staples, they're the least volatile. So therefore, in our world, actually you should start seeing our portfolios heading towards that as a direction. That we want companies that have an ability to price forward and actually think through how they carry that. And so the stability. The next one, though, was that we've realized COVID changed things. Because your current profitability versus your average profitability over 40 years, some companies haven't recovered to their true profitability. And the trick here, this is why fundamental investing is important, why you must study individual companies. Because over here, what is interesting is that when we look at energy at the bottom, energy's profitability globally, including South Africa, which is then a company like Sasol, that profitability hasn't recovered fully from the COVID lows. And so therefore, for us, yes, it's volatile, but wow, as high as the oil price goes and as low as the rand goes, wow, oil companies are actually benefiting. And so what's on the other side, though, what is scary is that information technology, those companies benefited from COVID. And so therefore, they're over-earned. Their profitability is extremely high. And so in our portfolios, we're saying, hey, we've got hospitals and energy, and actually tech, we're underweight. Why? Because tech's profitability is now starting to come under pressure, and I'm going to show you that later. But again, there's another way to look at it. Changes during inflation periods. You can see the biggest benefit, the biggest winner, if you want to put that in a portfolio, is energy. So energy, again, Sasol. Materials is resources or commodities companies. At the bottom here is information technology. Communication services are telecommunications companies. I'll explain that a bit later, but information technology, again, doesn't quite win. And this is a global thing. So you've got to know where you're fishing. If you're going to fish, build a portfolio, make sure you're fishing in the right pond. So why do we remain bullish on Sasol? This is Sasol, and basically what we do here, we plot the Brent crude price with the Rand dollar price, and that should tell us it predictively explained the share price until 2019. 2019, Sasol obviously went and built this massive plant in Louisiana. It was a disaster. They spent too much money. And obviously, we live in a world of ESG, now concerned about ESG, environment, and so there's a discount. So we look at Sasol, we say, hey, we held this company, and we've profited. It's been the biggest alpha generator in terms of our portfolios. But you can see Sasol still trades at a very, very big discount relative to its implied price. And in fact, it's underperformed slightly over the last few weeks while the Rand's been falling. The Rand is a bigger delta to Sasol than actually the oil price. And so Sasol is going to make probably, I think, the biggest earnings growth in South Africa over the next 2 years, provided Rand oil price stays there. And so for us, we still see an amazing opportunity here. Part of it, though, is that because of ESG in the world we live in, remember Economics 101? Remember when I first got to UCT, studied economics, laws of demand versus supply. Green line is a reserve life of wells. So supply is reducing. Why? Because everybody's fighting oil majors and everything about investing. No, we want renewables. That's good, but it has consequences. Demand in a world that is recovering is increasing. And Economics 101 dictates that when your supply is shrinking and your demand is rising, the price will react. That's why the oil price is where it is, and that's why likely to stay where it is. That's why inflation, if it stays where it is, will likely stay as high as it is. From our perspective, this presents an investment opportunity, this gap over here. The other side of it is Tencent, which is what Naspers hold. Gaming company and social media companies, the chart on your right and my left, you can see gamers in China have peaked. Regulation threw a spanner in the works there, that actually there aren't that many kids gaming anymore. And if you look at GDP per capita, the wealth in terms of gaming, Chinese spend a lot of money on gaming anyway, so actually there's no upside to that anymore. Now the consequence of that is that these are earnings, profitability, you can see it's reducing. Why? The profits have peaked. And yet the multiple is still running at what we think is a high multiple. And that's before you add the charts that I showed you earlier on about inflation. So inflation is not great for tech companies. So from a tech perspective, Naspers, we remain underweight, primarily because I think profits have peaked, and we see that this multiple is too high for a business that is now X growth. It's provided fantastic returns over time. We've benefited from that, but actually, you need to think about it. So South African equity, 2022, we believe the landscape is changing. We are more selective on our South African equity exposure. We remain overweight banks. Banks win in rising interest rate environments. Why? Every day, every time the SARB increases interest rates, you get an email that says, hey, you're now getting more in your fixed deposits. And actually, that stuff is good for banks. And banks' earnings rise until, obviously, bad debts come. But banks, we believe, are good. We've reduced our recovery plays because some of them have recovered. But at the bottom there, we've added to hospitals. And again, saw that. South African hospitals recovering from COVID, their profitability isn't where it should be. And so for us, that is interesting. And then we've added a company like MultiChoice, which again has some stability in earnings and obviously has high exposure to Africa, which produces oil, especially Nigeria, and that's interesting. Again, we've got MTN and ShopRite, which also benefit from that. In terms of our portfolios, balance fund and investors fund, you can see banks, we've got large position in banks, but then we've got large position in British American Tobacco. Why? It's stable. You can pass on inflation. Large position in MTN and Sasol. MTN's biggest business is in Nigeria. Nigeria is an oil economy. Again, why? You can pass that on. And Anheuser-Busch, largest brewer in the world. Again, because people must drink, and drinking is good, and our clients will benefit the more people drink. After I tell you all of this bad news, go out there and buy a beer from Anheuser-Busch. It's good. It's very good for clients. And so these are the companies that we're investing in. My final comment is on onshore, offshore. Now, in terms of what we've done, we looked at over the last 50 years and said, okay, cool, in terms of what are your recommended allocations from a balanced fund perspective. One of the things that we then looked at was take the top 2-3% in terms of total returns of funds required to deliver a CPI plus 5 mandate. And we looked at those and we said, actually, despite the changes that allow you to go 45% offshore, that's not optimal. We think 35% is the number. Why? Because the one thing people forget when they go offshore is this, that now you suddenly expose yourself to a rand. And the rand is unpredictable. From 1972 all the way, the one-year rand returns will give you whiplash. And so we think that if you go above 35%, you start eroding the gains of going offshore, and you start introducing some currency risks, which actually have always proven to be unpredictable. And so from us, again, Old Mutual Balance Fund, a long track record of creating wealth. Times are tough now. It is very hard to manage money in this market. But hopefully, I've painted a picture in terms of how we are managing your money and your clients' money. Thank you.